we should probably get started. We're a couple minutes in and we have a packed agenda, lots of different tax credits, some new details to discuss today. And certainly I suspect there's going to be quite a few different questions as well. So thank you very much for joining us today. This is part two of what may be a multi-part beyond two webinar series on the new CleanTech tax credits. First off, would like to do a quick land acknowledgement. CleanTech North would like to acknowledge that we are on the traditional lands of many territories, many nations, including the Mississaugas of the Credit, the Anishinaabe, the Chippewa, the Haudenosaunee, and the Wendat peoples. This is now home to many diverse nations, First Nations, Inuit, and Métis peoples. A little bit of housekeeping. We are recording, so we will be sharing this webinar. If you do have to drop off, we have a lot of folks that had suggested or requested that they get a recording of this afterwards, both because we're going to be covering quite a lot of ground, but also for those that had to drop off. So we are recording this. It will probably take a couple of days to process, but we will be putting it out afterwards. The Q&A should be live, so please do put any questions in that Q&A feature in Zoom. We're going to try and address as much as we can. If you have specific questions that are burning, please do put them there and we will monitor that. Right. Want to say a quick thank you to some of our great partners, the wonderful Export Development Canada, who's been a long-time partner and supporter of CleanTech North, Global Affairs Canada, Swan Law, the City of Toronto and the Startup Here program, and the Canadian Open Data Society. Representing, I suppose, those sponsors right now, thank you very much, Lynn. It's always appreciated to have your support. Well, I see the questions are already starting to come in. So today we have the same panel as we had for part one of this series, and that was on purpose. We want to have a little bit of continuity to the questions and answers and thoughts between the two webinars now that we have the budget out. So, of course, myself from Venbridge, CleanTech North, and the Ontario CleanTech Industry Association. We have Jigna Shah from Deloitte, from the incentives practice there, partner there. We have Jonathan Garbett from Dominion Tax Law, and we have Lynn Cote from Export Development Canada. Thank you very much, folks. They've all spent a little bit too much time digging into the budget to try and decipher read the entrails of what came out. So folks, thank you for all the pre-work that you did for this. Wanted to say a few things about the budget, and then I'm going to pass it over to Lynn. So there was lots of good in the budget, and not all of it CleanTech. So there's things like the Dairy Innovation Investment Fund, extra tax rate cuts for zero-emission vehicle manufacturers, and a $500 million bump for the next 10 years for SIF, and a little bit of a refocusing of SIF on the clean technologies, critical minerals, and industrial transformation side of things. So did really focus SIF on the CleanTech side, and we'll probably talk a little bit more about that. Overall, there's a few things. Some are good. The good things are that I went back and did an easy search of the PDFs of budgets from yesteryear. Went back to, I believe the original one that I opened up was 2010. It took until 2017 before I could find the word CleanTech mentioned. That's telling, because we are now 6 years later, and I didn't do a count of the number of times that clean technology or a variant of clean was mentioned in this budget, but it was probably the most used word in the in this budget. So that's a real sea change. And there's definitely organizations like Canada CleanTech Alliance, Octia, self-serving, and CleanTech North that have advocated for our clean economy. And I think, should certainly be proud of the advances that have been achieved there. So thank you. And that is great. There's definitely some new tax credits announced on that clean economy, clean future side of things, and we'll get into those. And we got a few additional details on some of the programs that were announced in budget 2022, as well as the fall economic statement. The less good is that we still see a bit of a limited scope as to what clean tech is. So things like AI and clean tech, optimization of systems, it doesn't really fall into the structure of these credits at this point. And we can talk about that a little bit more as well. There's definitely a bit of a slow rollout going on here, and I worry about that with respect to some of our other tax competition jurisdictions that we are working to keep companies here against, and the fact that the manufacturing tax credit isn't even rolling out January 1st, 2024. That to me is a bit of a problem. There's definitely still limited details on the other core programs as well, and we'll get into that. And there was not a production tax credit. There was manufacturing tax credit, which is one time for capital equipment, and in Ontario's case, the Ontario tax credit, a 10% bump on buildings and things like that, but no production tax credit. So there's definitely some things that need to be focused on. And finally, we got some criticism last time about talking about SR&ED a little bit too much last time. And there was really a question as to why are you talking about SR&ED? And the reason is we don't have enough details. So we're using SR&ED as a proxy in a lot of the cases to try and intuit what the function of these programs is going to be. So sorry, not sorry, blame Canada, I don't know, but we're definitely going to probably use that as a little bit of a mental model, but we'll try not to do it too much. So with that, I'm going to stop sharing and welcome our panel, and maybe pass the mic over to Lynn.
Thank you, Brian. Merci beaucoup. Good afternoon. Bon après-midi. EDC is very, very pleased to participate in the what may be a recurring series. Maybe we'll make it to Netflix on the investment tax credit. If you were diligently listening to the budget last week and you're still scratching your head, don't worry, you're in very good company. Lots of people are trying to figure out what does it all mean. I think the good news is we're actually trying to figure out something. There's something to work with. Lots of mention of clean tech in the budget, which is great. And as usual, the devil will be in the details. But I think that most people who are in clean tech are really quite happy that there is so much there to get our heads around. So I think what we're going to try to do today is give a little bit more context on what was in the budget, what it may mean, what you maybe should think about. And again, using that, what we know, SR&ED, to get into a little bit more detail. And on that note, I will let it go over to the real experts. But if you are a client of EDC's and you're not sure, call us, call me, call your account manager, your relationship manager. Talk to Brian. He can put you in touch with one of us. We are not the experts in this, but we're trying to, with the help of experts, figure out what it means as companies come to us with projects or deals, and see how we can figure out what it means from a capital stack perspective, from a timing perspective, because we all want the same thing. We all want projects to get going so that we can collectively reap the environmental benefits. So over back to you, Brian.
Thank you very much, Lynn, and thank you for your ongoing support and patience as we enlist you for more and more of these sessions. So thank you. And it's interesting, the devil is in the details, and so is the bankability. And putting my Venbridge hat on, we want to be able to, or I certainly want to be able to see how we can fund these tax credits to have companies doing things in parallel, not series based on their fiscal year end. But there's just no way to even assess that bankability till we get those details of those tax credits. So we really do need to know how these are going to work. So with that, I want to throw it out to the panel. We've looked at this sort of pantheon of new tax credits. Is there anything that you see, and I've got a couple things, but is there anything that you see that is sort of universal across all of them, that companies should be taking into account, things that they should be thinking about when they are applying for those tax credits, whether it's CCUS, whether it's hydrogen, whether it is the electricity. Is what are those few things that sort of span all of those tax credits? Things that jump out to me are things like the labor restrictions or requirements, and a few other things. But maybe I'll toss it over to Jigna or Jonathan. Any thoughts?
Yeah, I can just start really quickly there, Brian. And hello, everyone. For those of you who don't know me, just quick introduction. So as Brian mentioned, I'm a partner here at Deloitte in the Global Investments and Innovation Incentives practice. So in this practice, we support companies of all sizes and all industries with their needs for non-dilutive financing. So as Brian mentioned, programs such as the SHRED tax credits and a number of other government grants and incentives, including the CleanTech ones that we'll be talking about today. So one thing I noticed within the common element that you mentioned, Brian, for all the programs is the fact that it doesn't matter what stage you're in, from a company that will actually be developing or manufacturing or assembling, everything from start to finish, whether it is any component of the cycle, you will likely have a program that you'll be able to take advantage of. So there's a number of different clean tech programs. We talked about the clean tech hydrogen, the clean tech ITCs, now the electricity one that's come in. The great thing is, even though some of these are not stackable, the truth is, no matter what stage of the business you're at and what you're doing, whether you're one that's actually manufacturing the clean tech or implementing and using it, there is a clean tech credit that you could take advantage of, which I thought was pretty neat about this incentive.
Great, thank you, Jigna. And Jonathan, maybe give a quick introduction of yourself as well, and any thoughts that you might have.
So Jonathan Garbutt, Canadian tax lawyer. I deal with a lot of tax litigation matters, as well as planning and structuring for these types of projects. So the one thing that sort of was good about this was, as Jigna said, it's every different type, but they seem to have sort of filled in the gaps. And so what it means is it's not just every different type, but it's like there are certain things that are still not quite clear, but they sort of filled in the gap, because last time we were saying, well, we had this clean tech, but there's certain aspects of the electricity generation process that may not be included. And there was nothing that we had for manufacturers. And, last time we made this comment that, if you were just relying on what they had done, given what existed in the IRA in the US with their Inflation Reduction Act of the US government, that it would sort of be like, well, until and unless they gave some credits for manufacturing, it would behoove Canadian companies to just buy everything from the US and implement it here, because then you'd max out on the tax credits. And I have to say that we do have to eat our words on that one, because they did come back and say, yes, we're going to do something for the manufacturers. Like they stepped up. And then when it comes to the electricity 15% credit, they sort of, there was areas that people were concerned about, non-taxable entities. They're pretty much SOL on the previous set, because they don't file tax returns. They don't get tax credits. They don't qualify for ITCs because they don't have the necessary qualifications. So the 15% incentive sort of, like I said, sort of fills out the entire gap and the entire scope. Okay. Now, the other thing that I would say that sort of goes across the entire, all of them, is that I guess what I would say is that mechanically, this is the issue. And as Brian said about not sorry about talking about shred, but the problem is that if you look at the budget itself, it does not allocate any additional funds to the Canada Revenue Agency, NRCan, or any other organization to run this mega program. And Lynn, we spoke previously about sort of that this was in fact, kind of it was a surprise, but it was a good surprise because all the people who actually run these things were sitting there going, oh, this is coming our way. And they weren't, as because of the budget process, they weren't really informed in advance. And so there is going to be a huge sort of gap between, there's the intent here, and they've clearly put their money where their mouth is on CleanTech, put that forward. But then the mechanics of actually making this happen are still very, very unclear. And that's why that we keep saying, well, and to further on the shred point, I'm just going to try and wrap up here before I get too concerned about it, is that the CRA has no further and additional funding to develop any new programs or capacity or algorithms or software programs to be able to implement these tax credits. Therefore, when they do so, the only thing they're going to be able to do, because they have no additional money, is to piggyback on their existing programs. So that means that for the taxable entities, these credits will be delivered through the Income Tax Act. They'll be delivered through the income tax system, which means you'll have to file a tax return. Your tax return for a corporate entity is due 6 months after the end of the fiscal year in which you made the investment. So that's 6 months out. And then you have to file and claim these tax credits back, and that will take 3 to 4 months in the ordinary course. So this is not necessarily money that's coming up front. And as was stated before, the lenders, without this detail and without the exact mechanics of the forms and the documents and everything else, it's going to be very difficult to lend against. The other comment I would say is that the new credits that are for non-taxable entities, the only real algorithm in terms of what it compares to is the fact that certain charities are allowed to get investment tax credits on GSTs under certain circumstances. That's the only analogous method to distribute these funds that exists in the CRA's pantheon of programs at the moment. So when they get this new program for the non-taxables, they're going to have to bolt it on to that structure, because they can't bolt it on to the shred structure, which is what they'll do for all the taxable entities. They have no choice. We're not talking about it that way out of a belief. It's just, I don't know how the CRA could possibly get their computers to do it otherwise, right? They just, the last thing that we want is for the government of Canada to say that they're going to develop a new software program, because we all know how well that went. So
I think most people have been paid by now.
Yeah. So we do want them to bolt it on to existing structures. So that's, I'll get off because I know I've been going on for a while, but the key issue is non-taxables. It's going to flow out like a GST credit. Taxables, it's going to flow out like a shred credit, and I don't know how it's going to operate any differently. And that's a given. There's no other way we can talk about this. So sorry about talking about shred, but
no, but this is the infrastructure that in the vacuum, and my hope is possibly the part 3 of this, we can have somebody from CRA and somebody from NRCan here with some of those details, because I think everybody would really like to hear from the source how this is going to roll out. One of the areas that I found interesting, and there's still sadly here a lot, I believe the term was details will be announced at a later date with respect to all the labor conditions, prevailing wage, how that's going to work, and that really does span to maximize all of these tax credits. There's a whole section on the labor conditions under which those activities are undertaken. And there's not a lot of detail there. There's some around the prevailing wage and what that actually means, and there's some around the apprenticeship side of things, and then various other things. But it's going to be a bit of a watch this space for that side of things. Why don't we get into some of those new tax credits, just conscious of time. And there really were 2 main ones that I think we should should probably focus on today. Those were the electricity tax credit and the manufacturing tax credit. I think maybe we could probably hop into the manufacturing tax credit first. And I don't know, Jigna or Jonathan, is that something you want to talk about a little bit? Maybe Jigna on the manufacturing one in particular?
Yeah, sounds good, Brian. So as you mentioned, one of the new credits that came about is called the Clean Technology Manufacturing Investment Tax Credit, and it is a 30% credit. So similar to the Clean Tech ITC, if we kind of look at some numbers here, as opposed to the clean electricity, which Jonathan will talk about is a little bit less. The great thing about the Clean Technology Manufacturing Investment Tax Credit is the, well, not so much from the timeline really kicks in next year, but the good thing is the amount of different activities and expenditures that can be claimed under this, right? So we're looking at new machinery and equipment, specifically used to, manufacture or process clean technologies, extract, critical minerals. So there's extraction, processing, recycling. There's manufacturing of renewable or nuclear energy equipment, which is a new addition as well there, which is great to see. And then you've got, again, the nuclear fuels and heavy water, the manufacturing of the grid scale electrical energy storage equipment, zero emission vehicles. So I thought that was kind of neat there, because with respect to the vehicles, they don't necessarily need to be vehicles that are on the road as the EVs that we think about. They could be off-road vehicles as well. So if you've got a forklift, if you've got some other kind of truck that is going to be having more of a cleaner impact, then you can actually take advantage of this credit, which is kind of neat to see as well. And then the manufacturing of or processing of certain upstream components and materials, which is another thing that is included in this clean tech credit.
Yeah, one of the additional few bits is that it does look at the refining side of things and the recycling side of things on the critical minerals side. So that opens up the door for a whole other side of the manufacturing than we would traditionally think of. It's really that mining and value-added processing of the especially the critical minerals, and it allows for the recycling, which we haven't seen in the previous budget. So if I think of local companies like Li-Cycle, recapturing that lithium from spent lithium-ion batteries, there's various different things that previously wouldn't have been able to, that would not have fit the definition of manufacturing, but they've included that, which is really nice to see. One thing that should be noted, and you did mention it, is that doesn't take effect. You are not able to start accruing that tax credit till the January 1st, 2024, which aligns with the Ontario new 10% manufacturing tax credit, which there's some question as to whether those two can be used together or not. And Jonathan, you may have some thoughts on that. But I also had another question in terms of a term that they used for the equipment side, which was acquired and becomes available for use. Just thinking of our supply chains right now, available for use. Do you have a definition for that that you might be able to give us? Because if I was a clean tech company looking to buy some to do my manufacturing and needed to procure the equipment, I have to buy it now to be able to start Jan 1, 2024. So any sense on that side? Jonathan?
Nope, I unmuted myself. Thank you. Sorry. I always start talking and then have to mute. Unmute myself. So exactly. So acquired and available for use, but it's not available. So this is a little bit of a problem in the way that it's worded as a tax lawyer. If you're the CRA who might be adverse to giving you the money, and that is why I say, having the CRA make technical determinations is not a good thing, because they tend to be a little bit more tight with the money. So if it says, acquired and available for use, and it can't really start until 2024, does that mean that you can't order it now, even if it becomes available for use then? Because it's an and. Okay, it's not a or. If or was in there, then you would say, you know, and subsequently that it has to be acquired and available for use post 2024. That would mean that if you ordered it now and it didn't become available to then, is it eligible or is it not eligible? And I don't know the answer to that. Now, if you read that generously towards the taxpayer, which is what the interpretation should be of an incentive program, is it should be in favor of the taxpayer. However, the CRA does not read things in favor of the taxpayer. They read things as compliance programs. And they would say, well, you bought it in 2023, but it didn't become available. Sorry, you don't have both of those post January 2024, you don't get your credit. That is a risk for the way that it would be interpreted. But that what we're seeing there is not the wording of the, the exact language of the act. We're seeing sort of the sloppier language of the budget, which doesn't have the order, the Ways and Means Committee of Parliament with the exact language. So watch that space for how it's strictly defined. And when it comes for the available for use, they, the question would be, well, let's say we've got it running, but it is not producing in full commercial capacity. Is that available for use, or is it still being beta tested? Are we still doing that? Does that qualify? I would say there's again, in favor of the taxpayer, it should be that if you're using it, it's available for use, but that creates a potential problem for a dispute that may or may not, need you to litigate to fight it. So we'll see what happens when we get the actual language of the Ways and Means Committee. But until then, it's kind of up in the air, and that's not good. So no. I'm looking forward to seeing the language so that I can give you a real opinion on that.
Absolutely. Jacob, did you have any thoughts on that one, or? Okay. No, I think that, those are the sorts of small things that we're going to be monitoring, and frankly have been monitoring since budget 2022 and the fall economic statement for clarity on, and haven't seen. Now, we did actually see in the supplement to the budget, there was some detail sent to the Ways and Means Committee there, Jonathan. Not a lot, and mostly on CCUS, but it's, they're starting. So that's good.
The CCUS has a way deeper set of understanding. It seems like that's the one in which they are the most advanced in terms of actualizing this into legislation. The other ones seem to be behind on that, and so I think it's successive. They're trying to get one right and move on from there, which is a good way to go. Trying to grab it all at one time might not be as effective. Did you want me to jump into the talking about the, okay. So the other one is the Clean Electricity Investment Tax Credit. And what makes this, I tried to try and figure out, well, how is this different than the Clean Technology Investment Tax Credit? Like, what separates it? When you look at what is available, it looks kind of like the same kind of things. It's a lot of the same types of things: battery, solar, abated natural gas generation, all kinds of things are in it. I think the biggest distinction is that I don't think it's designed to be as much of an add-on to the existing technology base as to allow for a broader group of entities to obtain it, such as crown corporations, publicly owned utilities, First Nations, pension funds, which was interesting. I'm not certain how pension funds would have this, this need for a technology. It's a fund and not an operating company, but interestingly enough, creates an opportunity for financing. And so the idea that many of these non-taxable entities would have access to this, and it also sort of is very clear that it expands the base to new projects and the refurbishment of existing facilities, which I think is somewhat, it's interesting in that these effectively what it means is that if you are a taxable entity and you're doing a refurbishment, you could qualify for this 15%. And it sort of expands that area of opportunity for taxables as well. So there is a little bit of overlap between taxables and non-taxables, but I really feel, and you know, please jump in and tell me I'm wrong here, that the 15% was for the most part designed to allow non-taxable entities to gain access to additional funding, and that there was a great deal of discussion, and the you know, a lot of it was to be, you know, TBA, but there was a discussion that the government will in fact engage with First Nations and provincial governments and utilities in order to sort of optimize the modalities of how this is going to happen. And that says to me that, you know, for many entities, like I said, the only algorithm for this is the ITCs that some charities get, but it may be that they are going to work on sort of some way of just directly making agreements on case by case basis to give out these ITCs. And that might be a little bit more effective given that many of these entities don't actually file tax returns of any kind to date. So, or a specific type of return that would give an ITC. So that's what I think. So, you know, on that one, Brian, do you have any sort of?
Yeah, I mean, the only other thing that I would say it does include, which I don't think was in the previous, was the things like transmission and all the equipment around that. You know, if I think of some of the communities that I know that have an Indigenous-owned power transmission line that's going into the very far north to connect, I think it's 6 communities with one of the Clean 50 prize winners. You know, there's some really interesting work to build out that grid and that transmission line. So it would open the door for that sort of work as well, which is great. The refurbishment side of things, or the repowering, you know, where I really think that could be quite powerful, is, you know, there are lots of wind farms and various other renewables that were built 10, 15 years ago. Those are starting to need to actually be repowered, you know, new turbines and retrofit. And so this would allow that existing infrastructure to be repowered where it wasn't in the past, past tax credits where that wasn't an option. So I think those are two sort of new aspects of that one. Jake, anything on this one for you?
No, nothing other than what you've already covered off there. I think the one other thing that we should distinguish between the CleanTech ITC and this one is the fact that with the CleanTech ITC, you can actually stack some other grant programs. I'm not sure if you can with this one. I didn't see anything around that, but I know for the CleanTech ITC, there is some stacking available. So I think that was a good preview there.
Yeah, absolutely. Okay, Lynn, did you have any thoughts on either of those two tax credits? I have one last question, but I want to throw it out to you first.
I mean, not thoughts per se, but I'm sort of thinking of myself and thinking of our customers. And if I'm a company and, you know, either I'm planning a project, let's just, you know, renewable project with energy storage, like, and 30% is significant. So what do I do? Like, you know, it only comes into effect on January 1st. I'm not sure about mechanism. Like, you know, like Jonathan said, can I pre-order everything? And if the project is going to be, you know, go live in February next year, I'm still okay. So that's like one of the questions I'm kind of wondering for companies. What do they do in the meantime, and what can they do, and what's prudent? Because everybody will want to maximize that availability. And then for the investment, the clean electricity investment tax credit, I think the idea of refurbishment is really cool. And when we think of, I'm just, you know, using the example, if I'm a food processor based in Canada and you know, I export a lot of my goods, and I know that I have to do a fair bit of refurbishment to, you know, do a better job of how I use electricity, and potentially even, depending on where I'm located, start to generate my own. And so, like, and we talk a lot about this in the sense of decarbonization of. So, is there anything in it for those types of companies who are saying, well, I may not be a generator, but I may be reducing my use through specific investments? Like, is it, you know, what does that cover me there, or am I covered under the clean technology through the purchase of the equipment? So I think I'm just trying to think about, okay, what do you do if you're a company, and depending on like where you know, because ideally not everybody is, we know that not everybody's going to be a clean technology equipment manufacturer, but ideally everybody's going to be an adopter of some kind as we, you know, move into a place where we want to be more efficient in our use of electricity. So, and I think Jigna's point about everybody could be there, you know, somewhere, does that include, you know, companies who are not clean tech companies, so food processors? So that's a lot of more questions than answers, and I am answering right now a question on contract for differences, which is probably unsung hero of the budget, and I'll answer that. But just to say that that's going to be managed through the Canada Growth Fund, and PSP will be managing that. So, you know, more to come on that, but that's something to pay big attention to.
John. Oh, mute.
So bad at that. Okay, because Lynn, PSP, who's PSP?
It's a pension fund. So the Canada Growth Fund will be managed by the Public Service Pension Fund. So the in the budget, you know, the government is going to have to make some legislative changes to allow them, you know, whatever it is, to make the framework work, but they will be managing that fund.
Okay.
Absolutely, they're contracting that out.
It's very interesting.
Yeah, it's very different. Yeah.
Yeah. One of the things that you said about this refurbishment and for companies that aren't necessarily in that area, I think what it will mean is that when you go into, you know, if you buy a new piece of equipment, for example, anything, well, you might not have the right power connections in your building to do this. You know, you might not have the right panels or the right, you know, and I think that this 15% credit would go into, effectively, you're going to buy things and buy products, and you're going to have to list them out as to what you're buying, then go back and say, well, is that, you know, the CleanTech, or is that the electricity? And each one of them, and they're going to have to be broken out. Now, the reality is that when you do a tax return and you create like your various investments into various types of, like, if something's a category 4, category 8, you know, building or a type of refurbishment, it's clearly going to be, you know, into the 15%. You're going to have a hard time getting into 43 on something that's going to wind up being, you know, an integral part of your building. But if you have to rewire your building in order to be able to have these solar panels, just because otherwise it's not going to be safe and you're going to have to do it, I think that would qualify. So I think it does create this opportunity. And as you said, so a company that then just, you know, put in little things like, let's say, you know, they put in, you know, ultra efficient, you know, like light tubes, or refurbish the way that they just deal with their electricity. I think they could qualify for this. There's other programs, but this program I think would be available. The one other thing that I wanted to mention was with, you know, you've got these non-taxable entities that are going to be getting tax credits. And, you know, so that's something that's very new and interesting, but it creates the opportunity for those entities to then be able to sort of self-fund certain things, which I think is important for them to be able to sort of, you know, stay on track. And manage their budget needs. So I think that's probably one of the more interesting ones. But I think at the end of the day, every single project is going to have to be broken down into various pieces for you to be able to know. One comment as the tax lawyer, I did notice that in certain of the investment tax rates, they have used sort of what tax lawyers call magic words. One of the, or little phrases, one of them is all or substantially all. So they say all or substantially all versus principally. Principally means more than 51%. Okay, so greater than half of it is used principally for this particular purpose. And some of them it's all or substantially all. The CRA strongly believes it all or substantially all, and I think it means 90%, but the CRA has lost so many cases on that, and all or substantially all, everything after the or doesn't count, and substantially all, or anything before the or doesn't count. So it means 75% if push comes to shove. But you don't want to get into that if you have to. But, you know, so basically you're looking at in order to qualify, 50 to 51 to 75% of what you're spending has to be within that area. So I think all of these credits allow for a certain, in addition to things that you might think might qualify, there might be other things that you could do that are sort of adjacent to or necessary or required by these things. And so the amount of the scope of the tax credit has been expanded quite substantively by the language that they've used in this budget, particularly when it comes to what I would call, using that word principally. That gives you a lot more scope, a lot more rope to run around with than the all or substantially all language. That's about my observations.
Thank you. No, that's good. And one of the points that you raised before, I just wanted to focus back in every one of the tax credits. They did have a lovely line that was basically that these tax credits, in CCUS, hydrogen, CleanTech, etc., manufacturing tax credits. Sorry, where are we here? Sorry. Basically, the tax credits, you can only use one for any one piece of property. Multiple tax credits could be available for the same project if the project uses different types of eligible property. So in those sorts of cases, are you talking about the individual, and you mentioned a number of different categories, and that gets into a level of accounting that is beyond me, of different assets or expenses. Are those well delineated, such that companies can elect to have, I know the Ontario tax credit, we're not really focusing on that right now, but it was two different categories. One was for buildings, one was for machinery. Are those categories sufficiently well articulated to allow companies to parse out all the different pieces of tax credits and assign them to the appropriate tax credit for that piece of property?
I think to answer that question, Brian, there are a number of different classes that have been identified. And I think depending on the type of property it is, yes, we can identify which class that would fall under. But just to go back really quickly to Lynn's earlier comment about what if you're a food and manufacturing company, can you take advantage of some of these credits? I think one thing to note specifically for Ontario, and I know our audience is nationwide, but if you are an Ontario company with a new Ontario manufacturing tax credit, that's the 10%, that is an additional, credit to consider for any of the equipment purchases, manufacturing related expenses. So I think there's so many different categories and different tax credits that we could look at to really find dollar for dollar every expenditure that a company is making and support them with that, right? So there's just so much there. It's just now the devil's in the details.
So Jacob, if we open the Pandora's box, so I'm going to look a little deeper. We're talking about the Ontario tax credit, which does allow for buildings to be in there, which was an interesting surprise. Yeah. The CleanTech tax credit, the manufacturing tax credit, I do not believe does include the buildings. So if one was to want to say leverage 40% tax credit rate, would you load the Ontario? Could you load the Ontario, the buildings cost on the Ontario tax credit, maximize that out, and then leverage the rest for equipment? Would that be a good strategy, I suppose?
Yeah, exactly. And that's what we're really looking at doing. It's really determining what are all the different expenditures that a company is incurring, and then figuring out which way do we stack, which one do we first maximize, and then take advantage of the others. So that's really the thought process behind that, Brian, for sure.
I noticed a couple questions here on the CCPC, non-CCPC side of things. I wanted to address at least one of those. I believe, and correct me if I'm wrong, and the number of tax credits is starting to boggle the mind a little bit, but I believe all of these are available for non-CCPCs as well as CCPCs. Is anybody?
No, not the Ontario one, Brian.
No, sorry, not Ontario. No, correct. Yes, but on the federal side, I believe they can all be CCPC, non-CCPC, CCPC, and for those that aren't familiar, Canadian-controlled private company. So foreign companies that are setting up manufacturing, CleanTech operations, generating hydrogen, as far as I can tell, they can all leverage at the maximum rate, as opposed to, say, a shred, which is a much reduced rate if it's a non-CCPC. Any other, anybody know any differently?
Well, I think the details basically are as long as you're a tax paying company. Sorry, Jonathan, just a quick note there. Yeah, as long as you're a tax paying company.
Yeah, as long as, for those ones, I think they do qualify, regardless of whether they're Canadian controlled private corporation. We have to say that out loud because some people might not know what that means, but basically, so foreign owned corporations or public corporations, right? So publicly listed corporations are also eligible for these tax credits, and that creates a great deal of opportunity, because many of these companies are so smaller companies that are listed, and particularly in the mining sector and many of these other sectors where these companies tend to list first and ask questions later, that sort of precludes them from the from many of these tax credits historically, or has limited their capacity to benefit from them. So I think they've really opened up the doors on this one. There's also previously non-CCPCs would only get non-refundable credits. You not only had to be you have to be not only just a filing company, you have to be making profits for any benefit to accrue to you. You could usually sort of stack them up and wait until you did have profits, but they literally are refundable. So these are supposed to be cash in hand. Now, as we've discussed, the timing on when that cash is going to come is probably going to be a lot slower than what people would hope. But it is cash in hand, which makes it even more attractive. Now, I would say that if you are getting refunds of cash from the CRA, they do tend to be a lot more pushy on the audits than they are if it's non-refundable credits. That is just the nature of the beast, right? So and the idea that the CRA would find giving cash away to foreign-owned companies something they would enjoy is unlikely. So this is new territory for them. So it's going to take an attitude adjustment for this to come to fruition. So it is radical and new, and we need to accept that is going to be something that's going to be going to take some getting used to, particularly in the organizations that will be delivering this.
And Jonathan, you touched on hydrogen there for compliance for a little bit there, and maybe that's a good segue to sort of documenting a little or articulating some of the changes to the existing programs like the hydrogen program. One change there that I found very interesting was the assessment criteria. That this would be sort of ISO based assessments by third parties, as opposed to even NRCan, which we thought a lot of this was going to run through NRCan, and maybe this is indicative of the fact that they didn't extend the, as far as we can tell, the NRCan or CRA budgets. That third party assessment is going to be on you. What those look like, who does those, who's a valid purveyor of those assessments, it's sort of beyond the scope of a normal shred writer. So there's folks that are certified to do those ISO assessments, but there's a lot of that sort of language starting to creep in to certainly the hydrogen side. Any comments on that in terms of the compliance or the that as a mechanism? Any pitfalls or bonuses that implies?
Jingo, do you want to go on that one?
Yeah, no, nothing other than the fact that we're just waiting for the details in terms of what is going to be required. I wish I could say more, but I think really the advice we're giving to companies is let's just wait to see how the legislation rolls out, right? So hoping we can get some further news later this spring, and then by the time it rolls out closer to the end of the year. But other than that, I would say, just as we advise companies for any program, document as much as possible. That's really the advice I tend to give.
Yeah. So go ahead, Jonathan.
I was going to say on the documentation, and again, as previously, the fact that it's going to be NRCan and not Canada Revenue Agency that's going to be doing the technical aspect of it is a win for the taxpayer categorically. NRCan is going to be more. Sometimes when you get into CRA audits and assessments, it's kind of like they don't want to give it to you, so they're coming up with a reason. And you sort of get in that position sometimes And, you know, if it is objectively verified by a third party, so these ISO standards, the idea that it's an ISO standard, even though we don't necessarily know who's going to be qualified or considered qualified to do that, is a win for the taxpayer. You know, when you think about these things in terms of, these things are long-term, like they go to 2034. We could have a new government in place that isn't as enthusiastic about this and wishes to allocate funds elsewhere and isn't quite so enthusiastic about running huge deficits and might want to pull this back. And the way that you do that, as has happened in the past, is, yeah, turn the taps off, and they turn them off by telling the CRA the answer is no. Anybody asks, say no. And then you wind up with a fight. Whereas, and where they will say no is on the technical side, because they rather than anything else. And so if there's a third party objective stand saying yes, it qualifies, that's going to be good for the taxpayers going forward, because it's going to, shall we say, reduce any potential mechanism for the CRA to turn the taps off. And, you know, and that is something that is a risk abatement consideration. So I would say the same thing. You know, it's the same thing about, you know, the greenhouse gas intensity of some of the green or some of the hydrogen. They said, well, if you do certain things, you're going to get a higher credit. Well, who is going to adjudicate how that's going to happen? You know, that would require that there would be some sort of protocol that would be in place, some sort of procedure for determining how how that is going to be measured. What is the greenhouse gas intensity of a particular procedure? You know, are you in fact sequestering the greenhouse gases, and how do you verify that? You know, those are things that companies that are going to be in that area are going to have to start to wrap their heads around. And as I said, you know, as a litigator, you always want to line up your experts early and first. So, you know, you really want to get two experts in the area, in these areas, start talking to them. You know, like you said, you have to document everything, but what are you going to document and how are you going to document? So I would say that there's a great deal of opportunity for consultants and for professionals in these objective technical standards to start, you know, companies and investors should start talking to them immediately to try and get what they feel are sort of best practices from them, and talk to these experts about, you know, well, how do you measure that? Well, how does that work? And that would be the first step, especially for any of this, for the hydrogen. That is a technical issue, and further technical assistance is going to be important.
I like Yvonne's note here as well. I don't know if others can see that in the Q&A, that how ISO standards are set up, and it is that it is international bodies, not just the Canadian Standards Organizations that establish this. So it does add a little bit of distance from the political side as well. I've got a few specific questions here that I think it's probably worth starting to address. There are definitely other changes to other programs. So the clean technology, for example, was extended. There's other sort of small changes, but I think really until we get the mechanics of it, making it a longer program doesn't really matter if you can't access it. So I think it's probably worth hopping into some of the questions. One here from PH7, which is a green critical minerals processor in BC. They're saying planning to set up processing plant now, make it operational Q1 2024. This means we are ordering all the equipment now to be delivered in Q4. This means that the tax credit may not apply to us at all, since all will be paid for in 2023. Any thoughts, Jonathan and Jigna, in terms of do you slow the ship down? Do you leave it in Panama so you don't have possession? You know, what do we do here?
It is very clear that the credits specifically for the manufacturing side do not apply. It is clear that many of the other credits started, you know, are available as of budget day. So, you know, it's the same thing. You would line up all the various different parts of the equipment and try and optimize on that basis. You know, I think there would be a way that the CRA or whoever is going to be issuing the tax credits may have an issue with a facility that is operational in Q4 2023, I don't think you would qualify. That's the problem. Is early, in some ways, early adopters are going to be less able to qualify than wait and seers, which is not really what the intent was. And that seems to be one of the problems right now, and that is something that could in fact be fixed retroactively, and I think kind of needs to get to get done, and some lobbying might be involved just to say, well, there were companies that were first movers that are not going to get the credits, and then there are these, and then the Me Too people are going to get the credits, and that's not the intent. So I'm not sure that this was that aspect of it was particularly well, thought through. They just wanted to decide on a day, and they gave that, and the convenience for the manufacturing one of starting on the same day as Ontario. I get how that plays in, but and how that might be acceptable from a sort of, oh well, that's easy to do perspective, but I don't know that it's necessarily the right result. So I would have hoped that they might come back and change the date on that to date of budget, or even back to the fall announcement. You can't tell people go do this and then say, oh, well, by the way, you're not going to get it because you actually did what we said. That is some part of the program that has not been particularly well operationalized.
Yeah.
As hard as I can be.
Yep, no, that's good, and I know that we're starting to bump up against the end of the hour. We've covered a lot of ground in a little bit of a scatter shot. Want to give each of you a chance to give any last thoughts on the specific programs, the overall pantheon of clean technology. Maybe pass it over to Jingna.
Thanks, Brian, and thanks again for the opportunity. Like you said, I mean, there's a lot of stuff we know, but there's a lot of stuff we also still don't know, and we're still waiting to hear. So I think the only thing I would leave everyone with here is just, I know that sometimes projects can't wait to get started, and there are a lot of things that are happening in the planning stages. The best thing is to plan as much as you can right now. If possible, delay the start of some of the projects in order to take advantage of that. But if not, there are always other government grants and incentives that you could take advantage of if things need to move forward. So that's the one thing I would leave everyone with.
Great. Maybe Jonathan, over to you. Oh, mute.
I had to unmute myself. So the first thing is there's a bunch of questions that were in the Q&A. So Brian, what do you want us to do? Do you want us just to respond to them in like overtime, or what?
Yeah, I think we can go overtime and do a little bit of that. I just want to wrap up the official side of things.
So I've already said way too much. I'm going to keep I'm done. I'm done. I'll answer questions, but I'm done. So,
okay, sounds good. Lynn, any thoughts?
No, I mean, I think what's very clear here is that there's a lot of opportunities, both in existing programs and these new ones, and it probably is worthwhile for a company that's considering to try to get the timing right, and therefore get some external help to say, okay, if this is what I need to do, what's the best way to do it, and also to keep in mind that while we're all going mad for the beauty of the IRA, that hasn't passed legislation either. So there's nothing, the devil is in those details too. So, so I think that we're not necessarily at a disadvantage at the moment because there's a lot of the details that need to come forward on both sides. So my advice would be, get some specific advice and what works best for you, your company, and the project. And seek out the experts, and also if you have questions on the the CleanTech, the government things, continue to follow the Clean Growth Hub, which has a great website. It's a great resource for all clean tech companies. The minute that anything is announced, they're really good at providing updates on programs. So check that website, and if you have specific questions, don't be shy to fill out a request online, have a meeting, I think the more they hear from folks who need more clarity, they will pass that up because all the federal funders are represented there. So it's a great asset to use.
Great, thank you very much. And we will continue to answer some of the questions in overtime. But I did want to say that, you know, when I hear things like you know, wait and see, and you know, penalize early adopters, or structures that will penalize early adopters, my blood begins to boil a little bit, yeah, because I really do kind of wonder, how many forest fires and polar vortices do we have to endure while we wait and see? You know, this started to come out budget 2022. That was a year ago. We got a little bit more detail in the fall economic statement, and now we're being trickle fed to January 1st, 2024, when we may or may not be able to, you know, start to put together some manufacturing plants. So, you know, I do know that there's going to be advocacy. I won't say lobbying, but I will say advocacy, and probably some other folks will be working on the lobbying side around some of these nuances, because we need answers. We need to know how this is going to roll out, because certainly these tax cuts aren't bankable at this point. It's not something that you know, Venbridge could loan against. It's not something a company can even take and count on, like PH7. We've just had that example. So, you know, we need to know what those details are. So for any of those that are listening, please do take that message home and talk to your MP. I do know that certain ministers have been tasked with gauging the perception of the budget, and are out there doing so right now. So certainly do engage with some of those consultations. For now, I want to say thank you very much to our panelists. I want to say thank you to Lynn. I think I may have lost Jigna, but thank you in absentia, Jigna, if you don't reappear here. And Jonathan, thank you very much. Stay tuned for part 3. I think is sadly my my last comment, and we'll keep you up to date as these things roll out and as we get some of those details. If you'd like to stay on, please feel free. But thank you very much for joining us today, and we'll chat soon. Thank you.